Just tell me when we're live. Oh, okay. Hello, everyone, and welcome to MetaStock's weekly market roundup. My name is Hunter Smith. It is a beautiful day here in Salt Lake City, Utah on April 10th. We're very, very excited to have you joining us today. Let's go ahead and get the legalities out of the way, and then we'll get right into the roundup. This demonstration is designed to instruct you in using MetaStock and accompanying software plugins. It's not a recommendation to buy or sell, but rather guidelines to interpreting and using the specific indicators and features within the software. The information, software, and techniques presented today should only be used by investors who are aware of the risk inherent in trading. MetaStock shall have no liability for any investment decisions based on the use of their software, any trading strategies, or any information provided with the company. So we got that out of the way. Again, I'm excited to be here today. Today's guest is trying to figure out which box he's in. He might be in this box. Mr. Gary Burton is a returning guest of ours. He's done many events for us. And he has some wonderful analysis ready for us. Gary, you can hear me okay?
Yes, Hunter.
Okay, wonderful. Well, it's been another interesting week in the market. The US market here was a little bit interesting. We had a couple of gap up days, and we pretty much ended the week. And of course, today is Good Friday. By the way, happy Good Friday, everyone. But gapped up a little bit, and we had a little bit of, looks like what's consolidation. We gapped up again, but we ended with a doji bar, pretty much a doji on Thursday at the end of business. So have we hit the bottom? Is this the bounce we're looking for, Gary? It's a $1 million question, right?
That is, yeah, literally $1 million question. It's interesting how the markets are performing because it's the same in the Asian region as well, particularly in the Australian market. And I'm watching the US markets closely, but this recovery that we have is certainly money driven in the background, because the central banks around the world now, as everyone knows, are literally open, unlimited money available in the background. So we're seeing the markets driven on that. What concerns me the most is when you look through your watch lists now, you'll see companies that aren't actually doing anything, particularly the airline companies that aren't actually doing anything at the moment, and they're up 4% a day. So it's clearly a slightly dysfunctional market in itself. But if you sift through the markets now and look for, but particularly the medical sciences, the Gileads and companies like that, the medical sciences companies, a lot of in this part of the world, the mining sector is still very strong. And so there's still some trading, a lot of trading to be done that can be based on some fairly strong technical analysis.
Yeah, and it's you know, I've noticed a lot about a lot of what you've talked about. There are some things that are stimulus, but you know, last week or 2 weeks ago, I was talking about that stimulus, and it had just gotten passed, and we gapped up a little bit. But you know, again, the question that comes from that stimulus, at least in the U.S. market, is it false inflation? Is the movement up, the gaps up that we are seeing, is that people trying to call the bottom?
I think this is a bear market recovery. I think this is a secondary action within a bear market. And I'll go through some numbers around that in a moment. Unfortunately, in this area, I'm very old school as when it comes to the underlying analysis of the averages. So it's not I don't hold the view that because the market is down 20%, we're in a bear market, or because the market is up 20%, we're in a bull market. I certainly don't hold that technical view of the markets. I like to see how the market is trading, and I'll show just a little bit later on, particularly in the Australian market, we're seeing very strong volume days on the down days and lighter volume on the up days. Now, the market is certainly advanced off its lows, but it's that participation that worries me, that in this market, who's really participating in this, and it doesn't seem to be the broad-based investor. It's algorithm trading, of course, but it doesn't seem to be a real bull volume market at this stage.
Well, let's actually get into a little bit of analysis here. If that's okay with you, I'll go ahead and pass the screen over to you. Make you presenter. All right, should have popped up on your screen.
Hopefully that should be my screen.
It is, yeah. I see. Just the.
Okay, so I've got my charts. I've got my charts on a second screen over here. But I just want to point out something. This book here, can you see that? Am I still on camera there?
Yes. Mm-hmm.
Okay.
The Dell Theory.
Yep, Dell Theory by Robert Ray. This holds some really interesting text. I just want to read part of this. Can you see that, Hunter, there?
Yeah, go ahead and.
Yeah, so it says basically describes a secondary reaction in the market. Most important, it's the decline inside a bull market, or it's the advance in a bear market, usually lasting 3 weeks to many months. And during the interval, the price movement generally retraces 33 to 66% of the primary price change. That means that from our recent highs down to the recent lows a couple of weeks ago, we can look for retracements of 33 to 66% of that range. Now, the reactions are frequently erroneously assumed to represent a change in the primary trend, because obviously the first stage of a bull market must always coincide with a movement which might have proved to have been merely a secondary reaction. Now, this is, I take the view that this is what's happening in our market at the moment. We're seeing these secondary reactions. Now, I'll just go off screen here and pull this in here. So the first thing we can do is take a look at the Dow and its the current movements of the Dow. We can see here this, just move that out there. So we had the highs up here around 29,500 and the recent lows down here around 18,213. So we've been a decline of 11,355 points. Currently, we're 5,700 points off the low, which is about 51% retracement of what we call this movement down here, this correctional movement here. Now, this is a daily chart. We can actually go trade up into here around 25,700 and still be within that definitive range of a secondary reaction. So secondary reactions in the market are really defined when we see the price bars cross over each other or overlap each other. We can see a little bit of that here back in late March and early April, and certainly here the last 2 days of this, 3 days of this week, we saw 2 bars overlapping each other, and then Thursday's close here, a little bit of indecision there, being I think prior to this Easter weekend that we have. So currently we're about 51% up off the lows of this range here. Now, if you go back in history, everyone's quite keen to overlay historical markets over this. We saw at the top of the GFC 2007, 2008, we saw about a 30% retracement before the next phase of the trend got underway. And so I hold a view that this area here now, around about 24,000 to 25,700 for the Dow, will be the most interesting area to watch in this coming weeks to see how this really moves, whether it consolidates below these levels and starts to trend lower, because there is an economic reality coming. There is an economic reality coming for a lot of companies as they sort of navigate through government assistance and start to, particularly here in Australia, for example, the banks have now deferred their dividends. A lot of companies have deferred their forward guidance, and the general consensus is, and I think it's the same in the US, the general consensus is we may see at least a 30% decline in earnings. Now, that's not the stuff of a bull market, but it is the
No.
this retracement that we've got is a normal reaction, considering how strong the first reaction was on the way down here.
Mhm.
So I'm quite interested in the Dow having a look up in this range here, just below 25,700 range, to see how this reacts, and look for some form of reversal, some form of consolidation, and then a key reversal bar or a pivot point reversal bar, that type of thing in there. So it's excuse me, it's an area worth watching. On there, the next one is the S&P. Now, just for the people watching this, I use the Refinitiv side or the Icon side of Metastock to do my analysis because of other work that I do, but it still all works inside Metastock as well. Now, in the S&P, this is the weekly chart of the S&P. Very interesting. We saw 3 weeks ago an outside range or an outside period down here. And I would point out for the technicians that this market really did fail on a classic relative strength divergence. We saw the markets make a new high up here and the relative strength put in a lower high. It fits all of the, I'm going to go through this in the APAC presentation next week as well. There's a lot of detail around this relative strength divergence. But here we can see the S&P on a weekly basis has closed towards its high, has closed up in to test this support area around this 2820 area here during the week, and simply closed in towards its high. So a very strong move. It's around about 50% of the actual decline. So we're still in this, and I agree with the casual observation that it is a very strong move to get up here. We can see this bar this week in a shortened week as a large range compared to the previous week. So we look at that as being basically an impulsive move into the market. Now, again, if we saw this move in, I think 3,000 will be the key level on this psychological level for the S&P. But if we saw any sort of reversal or consolidation below this level, I'd be looking at this potentially to break lower. And 2,820 will be the go-to level on the way down, the first support level on any movement downwards. So it's we've got a corrective move underway. To get this into a true bear market trend, we actually have to break the lows down here around this 2,200. We have to see this market roll over and actually close below these lows to say, well, now we've actually got a bear market trend. We saw a short one here back in 2018 where we saw the highs, the lows, the market consolidated and rolled over and went into a new low. That could easily have been declared a bear market trend at that stage. And it's the only one in the last few years that's actually occurred. So now we have the opportunity to see this perform that way again, but it has a lot of work to do that in there. So the S&P also very strong move, but I still hold the view that we have a little bit of a secondary reaction. I'll just bring out the Australian index while we're here, and I have. So this is a bit of a close-up look. This is the Australian XRAY, our 200. We're seeing not the same sort of, and it's a daily chart, we're seeing not the same sort of action as we see in the US markets, but it has set these lows down here off this divergence, off this relative strength divergence, and moved a little higher. But I've got this expanded out. We can see here, I've got little arrows against the volume bars, And we're seeing a significant increase in volume on the down days as these days close lower. They're the days that we're seeing the high volume, and the days that we're seeing the high close, which was actually Thursday here, our market closed on its high, but we did it on fairly low volume down here. So there's a lack of real interest from the broader investors into this market. So without any further selling, it's not that hard to get a market up to close towards its highs. So it does look rather bullish closing towards its high, but I would argue that this consolidation area here over the last 2 weeks is simply a secondary movement within this first primary movement. So we're going to see this secondary range here. So for our market, this area of 5,600 I think will be critical. And if we saw any sort of reversal out of there in the coming days, then we'd look for the relative strength to fall below 50. And that would be the real giveaway that we're potentially putting in another leg lower on that. So it's great to see it. I think one of the best statements I ever heard around the markets was the market will always give you a second chance. So if there's something you did want to shift out, I'd be looking closely for that. When we come to look at copper, the copper contract, this is a weekly chart of copper. We can see that copper put in a very broad base, 18-month base here. Then suddenly, as the coronavirus started to become into the public arena, we saw it put in the highs in January. Then there was talk about a risk to global growth, and that really gave copper the impulsive move down to set this secondary market here, this congested couple of weeks here, few weeks here, and then the primary move has resumed. And currently we have another secondary market developing in copper. So it's not the type of price action you like to see inside a bullish move. We have the relative strength going from a little bit oversold, crossing back over the 30 down here, which is a natural reaction to these 3 weeks of upward movement. But this has a lot of work to do to turn itself into a bullish market. I would like to see the price of copper put in a higher low here somewhere in the next couple of weeks and then break that high. Yes, and then we'll come back and say, well, look, we've got something to look at here. But at the moment, Dr. Copper is not really factoring in any great industrial recovery at this point, other than a bit of stocking up after closures. So copper market's not really telling us. We can see the last 3 weeks have really pulled back off their highs for the week of the individual candles here, and this bearish formation has the risk of breaking lower and potentially testing the $2 area in copper. We can see in the background, overall in the background in copper, the trend is down. We had the highs out here back in June 2018, and we'll put in a series of lows and lower highs and lower lows and lower highs, and here we are again with a lower low. So clearly a broad downtrend in copper at the moment, with no signal that we're seeing this starting to recover there. So my favorite, I'll bring out this one here. This is a little hard when we look inside the oil market. This is the oil contract. I'll point out down here that the relative strength has down at 8.6 was its lowest ever. If you go back into your relative strength line on the oil chart, it just set the lowest ever I've seen in the data that I've got. Again, we saw oil consolidating through here. Then we had that massive gap open, that capitulation move on the Monday. And what we have at the moment in oil and setting again this week, we had an inside range this week. This is a weekly chart. So we had a large outside period or outside range, large range here. This hasn't followed through. It came up and tested a historical support level from back in 2016, 29.20. And this week we've seen an inside range. Now, I know there's a lot of politicking going on with around the oil markets in there. But at the end of the day, the market price has the final say here. So an inside period down close, and we saw the relative strength not make it over 30 and start to turn down again. So I would only suggest really at this stage further consolidation around these prices. A break of the low here would really have a lot of wrong-footed oil traders, if you like, because there'd be a lot of interest in buying at this price. But a break of this low would be quite catastrophic for the longs, I think, in the market. So one to watch, the initial movement will come with a break of this low, last week's low there, and then we see a break of the outside period low, then I would suggest that we would start to make a primary move again lower in the price of oil. So it's been a tough market for the bulls the last couple of weeks.
Yeah, across the board, and it's really interesting because it's a lot of this is, it's very, very hard to judge because we are in a situation where we've never really been before. We had a giant drop off that was spurned primarily over fear, but that fear was backed up with actual financial data. So when the U.S. comes in and posts the highest unemployment rate in a long time, there are real-time consequences and long-term consequences for all that's happening right now. And so I would agree with your summation where we could be in a secondary move that is natural after that much loss. However, I think that next week could be really definitive.
Yes, yes, it's the old saying that dance close to the door, as they say. Okay, we take a look at gold now on a weekly basis. A lot of the gold bugs will proudly tell you that this has outperformed every market, every instrument, and every market everywhere, and they're probably right. Gold had recently the retest down here at $1,450, which was a very good look, and then a very large range bar here set at late in March. Now I've got a note here that this is basically at the pivot point because it's closed over the high of the bar that's made the low. So this becomes the pivot bar. We saw a little bit of consolidation here at the previous resistance level at this $1,610.90. We saw a little bit of consolidation here with an inside bar, and then we broke to the high of the inside bar, and a very strong close this week on its highs. So I think the buyers have this, the bulls have this one. It did give a relative strength divergence sell signal down here. I guess it highlights you don't bet against the trend, and clearly the primary trend in gold is up. And we can see in this last grouping of bars in March and April is we're getting some very strong volatility in this market. Now, there's a gold VIX, if you like, the volatility index inside gold, that's starting to fall, which would suggest a further bullish move in the price of gold as well. So it's done, it looks like it's done the retests that it needs to do, and would be set now to really move a little higher. So clearly the high here, this high of 1702 is the key level to close over at the moment. But we have a very strong bar last week, a very strong candle closing in towards the highs, and would suggest that this may continue on here as an accelerated trend. We can see the original trend line down here really ends up around about 1440, but we're starting to accelerate away from that trend line. So I'd be looking for some form of exponential move in the coming weeks as this unfolds, particularly if we see the equity markets really roll over. I think we may see gold move a little higher on that. So at the moment, it's good to see the relative strength is over 50 at this stage. I don't go for the idea of sort of an overbought. It can easily move over 70 and still remain quite strong. So one to watch, but gold is certainly an interesting market at the moment. I think everyone has their piece of the gold market. Conversely, we saw, and this drives a lot of traders crazy, we saw the silver market not perform with gold, and silver has been in a primary downtrend. This is a daily chart of silver. Silver has been in a primary downtrend for months, and they refused to see it until we saw this final capitulation move down here in March into the $11.50 lows. There's a lot of discussion around this about silver not being a hedge against anything rather than just an industrial metal. And this, along with copper, silver took the hit on the market, looking at industry closing down around this health pandemic that we've got. Now, since then, I think this is what the silver bulls are looking for now. We have seen a significant movement up. This is the secondary movement in here, late March, early April. We saw this overlapping bars here. These are the daily chart. So we now have the higher low in here. So we have this nice little cup and handle pattern showing up with the break over this 1475 resistance level, a small consolidation, then last night a move out of there. So I would suggest that silver now may really take a look back at this $16.50 level. Very strong bar here on Friday, nice impulsive move. Breaking out, but $16.50 would be the obvious first target on this to monitor this again. And we can see that the relative strength is over 50, very positive sign, or positive momentum, if you like, in this material. This is has the daily movements here don't suggest a trend change just yet. You need to really see that in a weekly chart, but here this is very positive in the short term, at least for a retest around this $16.50 mark here. So looking quite positive, I think, quite positive for silver at this stage. Are there any, I'll take any questions there, Hunter, if there's any.
Sure, let's take a look. Guys out there on looking at YouTube right now, feel free to, maybe throw in a symbol or two, some markets that you'd like for us to look at, do a little bit of analysis on. Happy to answer any questions.
I have, this is the Australian version, if you like, of the VIX. The VIX is quite similar to this. The US VIX is quite similar to this, but we saw also a significant increase in volatility. And then as our Reserve Bank came in, and as the Fed did as well, started to inject capital into the markets, we saw the volatility really put the brakes on just then. Now, what concerns me, this is the area 3 weeks ago, we saw the real news that there was a global shutdown coming. And now we're starting to see a flattening of the curve, if you like, here, particularly in Europe, in Italy, and here, certainly here in Australia, we're seeing that as well. And so the volatility is coming, volatility values are coming out of the market at the moment. This is what we're seeing, this little bullish movement in stocks. So one to watch. What I don't like is it's up here off its lows. This is the Australian one, up here off its lows. So it's really not suggesting that this is all over just yet, based on a volatility point of view. But certainly we're getting back to more bullish levels from a volatility point of view.
Mm-hmm. We do have a couple of symbols coming in here on YouTube Live. First one is XLK. So I think both of these are going to be sectors, overall sectors.
Yeah. Okay. Now on my screen here, we could see I have two charts. This is essentially how I do my analysis on a daily basis. On the right-hand side is a weekly chart. On the left-hand side is simply a daily chart. And we're seeing this, when we look at underlying trends of markets, this is not a bad example here. When we look at underlying trends, we can see quite clearly on the weekly chart, we had a low here, we had a high, we had a higher low, and we broke that high several weeks later, went in to make a new high. So this is our uptrend in place. And when we saw, previous to that, we saw this corrective move down through here, really doesn't change trends. And that's what we've got in most indices at the moment. But this, we need this reaction and this higher low and this higher high. Over here on the right-hand side, recovery is good. We can see that recovery is good. We can see that there's an outside bar just here, an outside range. And I would encourage technicians, those that are learning technical analysis, go and have a look at how often an outside range where it makes a lower low than the previous bar and a higher high than the previous bar. Go and have a look at how often they show up at major turning points in all time frames, really. So we saw an outside bar, then a retest. This was the attempted retest of the low. And this is, at this point, all we're seeing is just simply this recovery against this corrective move down through here. So at this stage, yeah, it looks pretty good. The daily chart tells you pretty much the same. This day here, this is what we call a gap open sell, where it has gapped open and simply sold off. The high of this day will be the go-to area, will be the resistance area. So 86.68 will be the resistance area in the next couple of days. Having two inside bars like this against that is not a terribly bullish sign. We saw the same type of pattern just here, and it gapped lower. So this is not that encouraging in the short term just here. But we can also see in the volume study down here, the large volume yesterday and lower volume on the up day and large volume again on the down day. So there's certainly some committed selling, and if this is very similar across all the equities and indices. There's some committed selling or opportunistic selling in the markets at the moment on a daily basis. Sorry, Hunter, I'll go again.
Okay. Let's see here. SOXX. I'm assuming it's going to be another semiconductor.
Yeah, these 3 times, yeah.
Oh, sorry, SOXX, X-ray, X-ray.
Okay. Okay, so now, again, we could see a very strong move on the weekly chart down here and a recovery. This 2 weeks ago, we saw the attempted retest of the low. This week here, what would concern me about this is that it's closed off its highs of the week. So the market has finished here clearly, but finished well short of its highs. Here would be a little bit of concern. And we can see that here in the daily chart that yesterday put in an outside range for the day following an inside range. So an outside range here. This has high probability of marking at least a consolidation at this point or a reversal at this point. I would be monitoring, if I was long on this, I really would be monitoring that for a break of this low of Thursday's low of 215.46. We can see high volume down here on the down day, low volume on the up day, and high volume on the down day. So typical bear market activity on a daily basis. And we saw here these guys in here. So low volume on the up day in here, and it's really not a great look. From an investor, if you're longer term, other than a trader, it's not a great look from the investor's point of view.
Yeah, especially, pardon me, in the short term, looking at that, that there's still, it could be a secondary move. We could be bullish a little bit longer term on that, but that's
Yeah.
definitely looking like a reversal bar. As long as, you watch and you wait, I think that if it breaks that 190, was that 193 mark, somewhere around there,
Yeah.
if it goes below that, then we're looking at a longer term bearish trend. Am I correct?
Oh, certainly. Certainly, if it breaks this low here, then you have a number of buyers up here on the wrong side of the market, and this will be their signal that they're on the wrong side of the market. It'll attract two groups of people. One is those that with the ability to short sell, and those that are simply taking small profits from this buying down here, or taking their losses from the buying up here. So this is why that becomes these intimate support resistance levels become very, very important from a day-to-day basis. And it's really as simple as looking at where the lows are, where the buyers are, where the sellers are in your charts there. So it doesn't look. I think we would have seen a much stronger follow through. The fact that we saw a gap open here, this day here gapped open, this becomes a gap open sell. This day here gapped open high becomes a gap open sell as well, where we see days open with a gap and then sell off becomes a gap open sell. Not a terribly bullish sign. We saw one here, gap open sell in here as well. And including the up bars, if you have a look up here, we had this gap open in a high place, and that became the high of the market. We broke this intimate low down here, so all of the buyers above this level are wrong, and we saw the market sell at that point.
Yeah, it's the same thing with the move before that as well. One of the things that you have taught me that has actually helped my trading significantly is really watching for those higher highs and lower lows. And understanding that secondary movement does not mean that, basically it means that it really is just a secondary movement. So,
Yes.
if I'm looking to go long with SOXX, if I'm looking to be bullish in this, again, I can look at this and say, well, I may still be bullish on this long term, but I have to just be a little bit more patient, because what this can provide us is a better time to buy at a greater value.
So certainly. So from a trading point of view, what we're looking for is a better probability than really just taking a run at it. So looking for high probability entry points. I just point out again this weekly chart here on the right hand side. This bar here, this is what we would call the primary move. This is the secondary move, the overlapping bars here. Then we went into a primary move again on this particular entity, and then the secondary move, and then we broke again into a primary move, secondary, primary, and so on. So it's quite easy to discern how the stock is reacting, or how in this case, the ETF, but how it's reacting, which is your body of buyers and sellers, how they're reacting as a group.
Now looking at another one here, let's see. We have our marketing manager in YouTube chat, and he's wondering when his 401k is going to come back, and looks like he's having a little bit of an issue spelling the word symbol, but it looks like he finally figured it out. So 401k, it brings up a really, really good point. In the US, we've suffered a lot on our 401ks. In Australia, it is known as a super fund, I believe.
Yes, that's correct. And I would point out that super funds in general are anywhere between 30 to 40% off their highs at the moment. Particularly in Australia, super funds are largely built around dividend-paying stocks, the four banks, and after that, your large resource companies, and then your large retailers. And all of those are paying fairly strong dividends. So the super funds are built around that because they need to generate a return. But from a capital point of view, yes, the super funds, if you'd just left it alone, you're down 30 to 40% off the highs, in line with the, of course, in line with the movements in the underlying stocks.
Yeah, it's pretty much where we're at, and that's been begging the question. And I think that that's generated a lot of interest in the industry lately. Is
Yes.
okay, now all the eyes are on the market more than normal, saying, okay, well, when's going to be the best time to buy? Are there certain when looking at a 401k overall, are there certain things that you're looking at maybe trickling back into at this point, since they are longer term investments?
Yeah, look, without offering any investment advice, because we're not here to do that, I'll make that very, very clear. Having spent a number of years on the trading desk with private clients, and having worked through the GFC and the tech wreck, the ultimate message to particularly those with a longer term view is don't sell. That's always the message. This is a good time to maybe pick up companies that have better fundamentals than other companies in this particular environment that we've got. So, for example, utilities will do well in this environment that we have here. When we start to see real recovery, it seems that the banks will come back a little earlier than everyone else. And then, particularly in the US, you're looking at your big technology companies and Amazon, of course, the larger retail sales. So this situation that we've got at the moment, particularly here in Australia and in the US, I understand Walmart's doing quite well with its retail sales. Certainly here in Australia, the grocery companies, the Woolworths and the Metcash companies are doing extremely well out of this panic buying, if you like. But certainly their sales are quite strong. So that will fall away once this passes, and it will pass. They will fall away. I would be a little wary of that, because you may see some profit taking come in on that. But you're still looking for value inside companies that produce something that have growth ahead of them, that type of thing. So the biotechs in the US are quite strong. The retails at the moment are quite strong, but underlying that, it'll always be the banks that come back first.
Definitely agreed. Definitely agreed there. We did have one other symbol.
Yep.
IWM, which I needed a little bit of clarity. IntelliSat, is that, I believe that's what they were looking at.
Yeah. So the Russell Russell ETF here. So you'll notice, and this is one of the only charts that really actually put in a lower high prior to the corrective move. I noticed a number of technicians that I follow, particularly on Twitter, made note of this, that the Russell really didn't follow through in the last stages here, as the Nasdaq did. Interesting, but this really highlights this impulsive move, very strong movement here, and follow through. And down in here we have the secondary consolidation. So a good consolidation. Yes, this has closed up on its highs. Now you need to think about this from the Russell and the S&P point of view, that made up of smaller companies, much more agile companies than you will get, say, at the top end in the Dow. So these companies are very much more adaptable to this type of trading environment that we've got here. So the market may be factoring in that at the moment, but we had a very strong impulsive move here on this last week. This would simply be easy to see this following through, because we often see strong impulsive moves, particularly in off low price areas, follow through. We can see that the relative strength is now just crossing the 30 mark here. And on here, the daily chart over here, the up day yesterday, and this, I would point out, this is a gap open sell on Thursday, but it was being done on high volume. So in the short term, yeah, it looks good. There's a couple of gaps to fill in here. It's easily see this trade up and simply fill these gaps in on the way. I do like it when the relative strength here crosses the 50 mark. I really wouldn't be long anything unless the relative strength was over 50, particularly on a daily basis, and better on a weekly basis. If we saw the relative strength here over 50 on a weekly basis, that would make it into my book any week of the year. But this is quite a good look in the short term here at the moment from a momentum point of view. Relative strength is actually a momentum indicator, and so it's really showing we have more positive momentum in this last grouping of this look back period up in here. So yeah, quite a good look.
Wonderful. Let's see. Doesn't look like we have any other suggestions.
Okay.
As far as symbols. So, you know, any closing thoughts from you, Gary?
I think this. I've argued in the office here. We have a small trading office here. I've argued that this is the most interesting thing you'll probably see in your lifetime. These current markets that we have. I would encourage anyone not to be married to a short-term position in these markets. We are in historically high, not the highest, but we're in historically high volatility at the moment. I believe that we are in a secondary movement of a bear market unfolding, simply based around economic conditions that aren't there at the moment. And the market will just take a moment to sort of factor those in. The market's looking at Federal Reserve money at the moment, the propping up at the back end of the market as a positive, but I think the economics of all of this will come in at one stage. We're starting to see continued reports of 8 and 10% unemployment levels, with best guesses going to 20 and 30%. I'm not sure that the reserves banks will allow that to happen, but certainly this unemployment situation will take a long time to resolve. This is not a case of next week will everyone back to work. That we're seeing a number of corporate collapses at the moment, off market, not necessarily listed companies, but also off market. We saw a restaurant chain here yesterday say that they're not coming back after this is all over. So the market has to deal with that going forward. And I would be very cognizant of the fact that once it really understands more of those figures, we may see a lower market in the coming weeks.
I do agree with you. I'd love to think that we've hit the bottom, but I think at least there will be some very low-level consolidation going on for quite some time, because since it is the most, like you said, it's the most interesting thing that's really happened in the market for a long time.
Yes.
We do understand the repercussions of and the ripple effects long term on all of these different industries.
Yes.
There are industries that are built to be able to survive things like this, and there are a lot that are not.
Yes, yes, exactly. And it's the ones that are built to survive this are the ones you really should be looking at as first responders in a recovery of any sort. So for traders, this is the time to keep your position sizing small, because the volatility will take care of anything after that. If you position sizing is too large, volatility will take care of you ultimately. So it's a good time to learn to trade. I believe it's a good time to learn to trade on small positions, because we're getting lots of movement and lots of results very quickly. So an exciting time, I think so, Hunter.
Yeah, it definitely is. Keep your stops close and your friends at least 6 feet apart.
That's right. Yes, that's right. Yes, that's right.
All right. Well, Gary, thanks so much for joining us again. It's always wonderful to have you on. You mentioned it a little bit earlier. We are going to be having a APAC summit, Asia Pacific summit. It's like our online trader summit, except that it's geared a little bit more towards the Asia Pacific region. It's in the US. It's late at night when it comes on. I'll go ahead and put the link to register if any of you want to check out Gary and 5 other speakers. I'll put the link into YouTube chat just now. Go ahead and feel free to register. We have 5, and I like to say 5.5 market experts. I don't really know if I count as a market expert, but I'm a metastock expert, so I'm kind of halfway there. 5.5 market experts, at the APAC Summit. So feel free to register. I'm excited to have you there, Gary. Looking forward to your presentation. So thanks again. Also, all of you out there, stay safe. Again, don't panic with the market. Don't go all in on massive moves. Keep your stops tight. Make sure that you're focusing on your position sizing. It's a wonderful time to be able to make some money in the stock market, as long as you do it with caution, as always. If you have any questions, Gary, do you have contact information for yourself on hand?
Not really, just my email address, burton.g@telstra.com. I'll reply to your email. You can follow me on Twitter. I think it's CFTe Gary on Twitter. I post charts up on Twitter on a regular basis. And at the APAC Summit, I'll be talking about the underlying Dell Theory and looking at the relative strength.
Wonderful. Sounds good. Gary, thank you so much. All of you watching out there, be safe, trade well, and as always, happy trading.
Thank you, guys. Thank you, everyone.